Hello and welcome to U.S. Stock Insights.
Great to be here.
Today we're diving into Palantir PLTR. It's a stock that it always seems to stir up debate, doesn't it?
Oh, absolutely. You mentioned Palantir. People have opinions, strong ones.
And, well, the material we're looking at today couldn't be clearer about that. We have two analysts, two completely opposite takes, one pretty bullish, the other very skeptical.
Diametrically opposed, really. It sets up a fascinating contrast.
So our goal here is to unpack these two views. We'll get into the arguments, the data they use, and try to figure out what it all means for you, the retail investor, trying to make sense of it all.
Exactly. Not picking sides, just understanding the different ways people are analyzing this stock right now.
Okay, let's jump in. Perspective number one, the skeptic.
Yeah.
And they don't waste any time.
No, they really don't. The core argument is that the market, and Palantir specifically, is being driven largely by what they call naive retail investors.
Naive retail. And they define that as folks just chasing momentum, like is the stock going up or down, and that's it.
Pretty much. They argue these investors are totally ignoring conventional valuation metrics. They say Palantir is incredibly overpriced by any standard measure.
Okay, incredibly overpriced. What else?
Well, they talk about this inexplicable faith in future rewards, sort of ignoring the current facts on the ground, the actual numbers.
And they broaden this out, right, to the whole market.
They do. There's this striking sandcastle analogy for the market looks solid but could collapse from, anything, really. A random event.
A sandcastle market. Wow. And this is based on experience.
Yeah, what they call old geezer standards, suggesting the market is maybe over 100% overvalued based on long-term averages.
Okay, so deep skepticism about the whole picture.
Yeah.
And they mention professional sentiment.
Right. They cite a Barron's poll showing pros are the most bearish in 28 years since the dot-com era, basically.
Incredible statement. So the pros are hiding.
Many are neutral, which this author kind of cynically calls a pretty good place to hide. They also bring in Bill Smead, noting how weird it feels for growth stocks to be leading like this. It feels abnormal.
So the pros are wary, and this view says retail is driving the bus, maybe towards a cliff.
That's the implication. They focus a lot on that retail behavior, saying historically retail tends to, buy at the top and sell at the bottom.
Right, the classic fear and greed cycle.
Exactly. They reference Liz Ann Saunders talking about a gambling mentality, not about value, just wanting the stock to move.
Like crypto, I think they mentioned that parallel.
Yeah, bringing up Charlie Munger calling crypto rat poison because its value is just what the next individual will pay. The author suggests that kind of thinking is spilling over into stocks like Palantir.
Okay, so that's the market context. What about Palantir's own numbers, according to the skeptic?
They point to a few things. First, the lack of public operating numbers for its first 17 years. That's a long time.
And the debt situation.
Yeah, Palantir has no long-term debt now. Sounds good, right?
You'd think so.
But this author spins it negatively. Suggests maybe nobody wanted to lend to them back then when they were burning cash for 18 years.
Ouch. That's a harsh take. What about growth versus share count?
This is key for them. Revenue. Sure, it's up a lot since 2018, from around $600 million to over $3 billion TTM.
Okay, significant growth.
BUT. The share count has grown even faster, from about 537 million shares to nearly 2.3 billion.
Whoa! So what does that mean per share?
That's the kicker. Revenue per share is up only about 1.2% total over 7+ years. Tiny.
So dilution is eating almost all the top-line growth for individual shareholders.
That's the argument. They also say earnings, while finally positive, are minuscule, and buybacks are just soaking up stock compensation, not reducing the share count overall.
So fundamentally, on a per-share basis, they're just not impressed. Which brings us back to valuation.
Which they say buyers are ignoring. TTM, price to sales of 95, price to book of 56, and a TTM PE somewhere between 275 and 300.
Those are certainly high numbers by traditional standards, screaming overvalued in this view.
Right. They even point to the seeking alpha quant ratings. Valuation F, momentum A, plus A, growth A, profitability A, but the overall is just hold.
And that was cynical take on hold, right?
Yeah, you hold, I sell. They see it as a perfect stock for people ignoring fundamentals, driven purely by momentum investing. It's a momentum versus everything else.
And the price chart definitely shows that momentum, especially recently.
It does. A huge run-up in 2024, but again, for this author, it just reinforces the sandcastle idea. Looks good now, but unstable.
Okay, a very clear, very cautious, even bearish perspective, focusing on hype versus fundamentals and potential market fragility. Now, let's shift gears completely. Perspective 2.
The bullish case.
Right. And this analysis actually starts by acknowledging the retail presence in the rally. But crucially, they argue it might have structural legs.
Structural legs, meaning it's not just temporary height.
Exactly. Their core idea is that institutional buying is picking up steam, and that's providing real support. How do they frame the retail ownership? The first source saw it as a negative.
This one sees it as an opportunity. Palantir has, what, 41.5% public other ownership versus about 51% institutional? That's unusually high retail for a big tech name.
Compared to like Microsoft or NVIDIA, where institutions dominate.
Precisely. They argue this sets up a re-rating trigger. As more institutions buy in, maybe shifting towards, say, a 60-30 institutional retail split, that accumulation could support the price and even lead to higher multiples.
Interesting. So high retail isn't necessarily a bubble sign here, but untapped potential for institutional buyers.
That's the view. They do acknowledge the risks, like volatility, but they counter the bubble idea by looking at short interest.
People betting against the stock. What's happening there?
It's been decreasing even as the price has shot up. That's rare, they say. If it were just hype, you'd expect shorts to pile on.
So less short interest suggests the buying is more convinced, based on a real story.
Yeah, a solid structural growth story, not just a squeeze. It suggests both retail and institutions are getting comfortable buying dips instead of doubting the rally.
What about why institutions were maybe slow to begin with?
They touch on that. The direct listing IPO might have played a role, less initial institutional involvement. Also, governance concerns the founder's voting power.
Things institutions definitely look at.
For sure. But this analyst argues those concerns are fading. Palantir now has 8 straight quarters of positive metrics. That consistency opens doors for institutions that might have been waiting. They see institutions as catching up.
Okay, but the valuation. That 0.7% free cash flow yield the skeptic might point to.
They tackle it directly. They admit there's some amount of froth. That 0.7% TTM FCF yield is low because the price ran up so fast.
There's always a but in these bull cases, right?
Right. The but here is context. You have to see that low yield in terms of Palantir's stage of growth and momentum. You can't just look at the static number.
And they use a comparison to make this point.
Yes, Microsoft. They show how Microsoft's FCF yield also compressed significantly from maybe 12% down towards 2.5% starting around 2014.
And what happened to Microsoft's stock during that time?
It went up multifold, despite the yield shrinking.
So the argument is low yield now doesn't automatically mean bad future returns if the growth is strong enough?
Exactly. They argue Palantir's growth potential today is much higher than Microsoft's was back in 2014. So even if Palantir seems overvalued now, strong execution could still lead to very high returns.
Like 5-10x potential over a decade, they suggested.
Yeah, something like that. Even allowing for valuation contractions, meaning the PE multiple might come down, but earnings growth could outpace it. This whole view supports a buy and accumulate on dips strategy.
Okay, and they see signs the business itself is becoming more efficient.
They do. They look at the ratio of quarter-over-quarter revenue growth compared to R&D spending. It suggests Palantir is getting more new revenue for each R&D dollar spent.
So, better bang for their buck on innovation, moving towards monetization.
That's the idea. A sign the model is scaling efficiently, moving from just building stuff to actually selling it effectively. Supports the whole AI stocks narrative too, potentially.
So, summarizing the bull case, yes, valuation is stretched, but view it in context of high growth, improving efficiency, AI tailwinds, and importantly, increasing institutional support providing structural legs.
You got it. That's why, despite the valuation, this author remains bullish.
And the investment advice reflects that confidence.
Completely. For current holders, hold. For new money, consider starting a position, but plan to accumulate a lot more on dips.
Don't wait for the perfect bottom, because institutions might prevent it.
That seems to be the thinking. Expect volatility, expect drawdowns, but if the core story revenue growth, FCF growth, enterprise traction holds up, those dips are buying opportunities. Proper risk management is key, of course.
Okay, so there we have it. The skeptic sees an overpriced, retail-driven momentum play in a fragile market, warning about hype versus fundamentals.
While the bull sees a structural growth story with rising institutional support, arguing the valuation needs context and potential rewards justify the risk, advising accumulation.
Two very different lenses on the same stock. You've heard the arguments, the data points, revenue per share versus overall growth, FCF yield versus potential, retail sentiment versus institutional flows.
So the question for you, the listener, is how do these views resonate? Are you buying the long-term business potential, the structural story the bulls tell?
Or does the skeptic's warning about hype, momentum, and sky-high valuation metrics feel more compelling right now? Is it the business or just the stock price movement?
And critically, thinking about risk management, how does understanding these opposing forces, the momentum versus the fundamentals, the retail versus the institutional shape, how you might approach a stock like Palantir?
Definitely food for thought. And just a reminder, this is our deep dive into these specific analyses laying out their points. It's absolutely not financial advice.
Just aiming to give you the context and the different frameworks analysts are using out there?
It really is a stark contrast, the sandcastle versus the structural legs. One sees a bubble, the other sees a foundation being laid.
It really highlights a fundamental tension in today's market, doesn't it?
It does, and maybe that's the final thought to leave you with.
Yeah.
Does this era of highly active, often shorter-term retail investors, empowered by technology and information, fundamentally change the game?
Are traditional valuation metrics becoming less relevant, maybe? Or are we just in another cycle of excess that will eventually, inevitably correct back to those historical norms? Something to ponder.
Indeed. Thanks for listening to U.S. Stock Insights. If you found this useful, hit follow and stay tuned for more stock breakdowns every weekday.